In this video, we'll show you 3 growth stocks you can buy right now before the Nasdaq potentially enters its next explosive phase. These are dominant platforms sitting at the center of massive, irreversible trends that could define the next decade of wealth creation. What you're about to see are businesses that are quietly embedding themselves into the backbone of the global economy. They operate at scale, they benefit from powerful network effects, and they are positioned to compound for years as demand accelerates across industries you cannot ignore. Let's start with the first stock. Palo Alto Networks with ticker symbol PANW. This is not just another cybersecurity company. This is one of the central players shaping how enterprises defend themselves in an era where cyber warfare is a daily reality. The reason this business matters goes far beyond software. It is becoming a mission-critical layer of the internet itself. Think about what is happening structurally. Companies are moving to the cloud, adopting hybrid work environments, integrating artificial intelligence into operations, and connecting more devices than ever before. Each of these shifts increases complexity, and complexity is where vulnerabilities thrive. Palo Alto Networks is building a unified platform to address that complexity. Instead of offering fragmented solutions, the company has been aggressively consolidating cybersecurity into an integrated ecosystem. This includes network security, cloud security, and security operations, all working together under one architecture. This platform approach is incredibly powerful. Once a company adopts multiple modules within Palo Alto's ecosystem, switching becomes extremely difficult. The cost is not just financial, it is operational risk. That creates a strong moat and drives long-term customer retention, and the numbers reflect that strategy. Palo Alto Networks has been seeing strong demand for its next-generation security offerings, particularly in areas like cloud security and AI-driven threat detection. These are not short-term trends, they are structural shifts that will likely accelerate over time. One of the most important signals is the company's remaining performance obligations, which represent future revenue that has already been contracted. This figure has been growing significantly, showing that customers are committing to long-term deals rather than short-term spending. That is exactly what you want to see in a compounding business. Another key driver is the company's shift toward platformization. Management has been pushing customers to adopt multiple products instead of standalone solutions. This increases average deal size, improves margins over time, and strengthens the overall ecosystem. In simple terms, the more customers rely on Palo Alto Networks, the more valuable the platform becomes. Now let's talk about profitability and scale. Palo Alto Networks has been improving its operating efficiency while continuing to invest in growth. This balance is critical. Many tech companies struggle to do both at the same time. Palo Alto is proving that it can expand margins while still capturing market share. Free cash flow generation has also been strong, which gives the company flexibility to reinvest in innovation, pursue acquisitions, and return value to shareholders over time. And then there is artificial intelligence. AI is not just a buzzword here, it is directly enhancing Palo Alto's ability to detect and respond to threats faster and more accurately. Cyber attacks are increasingly automated, which means defense systems must evolve at the same pace. Palo Alto is embedding AI across its platform, making its solutions smarter, faster, and more adaptive. This creates a feedback loop where more data leads to better threat detection, which leads to stronger customer outcomes, which leads to more adoption. That is how you build a long-term competitive advantage. Another important factor is consolidation within the cybersecurity industry. Many companies are looking to reduce the number of vendors they work with. Managing dozens of separate tools is inefficient and increases risk. Palo Alto Networks is benefiting from this trend by positioning itself as a one-stop solution. This not only drives growth but also strengthens its relationship with enterprise customers, making it even harder for competitors to displace. Now let's zoom out. Cybersecurity spending is not optional. It is not something companies can cut without consequences. In many cases, it is one of the last budgets to be reduced because the cost of a breach can be catastrophic. This creates a level of resilience that is rare. Even in uncertain economic environments, demand for cybersecurity remains strong. And as digital transformation continues, that demand is likely to increase. So when you combine all of this, you start to see the bigger picture. You have a company operating in a mission-critical industry. It is transitioning toward a platform model that increases stickiness and margins. It is leveraging AI to enhance its core offerings, and it is benefiting from long-term structural trends that are not going away. That is the foundation of a powerful growth story. But here's where it gets even more interesting. As the Nasdaq moves higher, investors tend to rotate into companies that have both strong growth and clear visibility into future revenue. Palo Alto Networks checks both boxes. It is not just growing. It is building a predictable, recurring revenue base that can compound over time. And in a market environment where quality matters, that combination becomes incredibly attractive. This is not about chasing hype. This is about identifying businesses that are quietly becoming indispensable. Palo Alto Networks is doing exactly that. And if the broader market enters another expansion phase, companies like this are often among the biggest beneficiaries because they sit at the intersection of innovation and necessity. That is a powerful place to be. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second stock, and this one operates in a completely different part of the tech ecosystem, but it is just as critical to the future of the digital economy, because none of the innovation we talk about, not artificial intelligence, not cloud computing, not autonomous systems, works without one thing: data storage. Every photo, every transaction, every AI model, every enterprise workflow depends on the ability to store and retrieve massive amounts of data quickly and efficiently. And as the world becomes more digital, the amount of data being created is exploding at a pace most people underestimate. This is where SanDisk with ticker symbol SNDK comes into focus. This is not just a legacy storage brand that people associate with USB drives or memory cards. What makes this business interesting right now is its position within the broader evolution of flash memory and data infrastructure. The global demand for storage is entering a new phase. We are moving from a world where storage was primarily consumer-driven to one where enterprise, cloud providers, and AI workloads are the dominant forces. And these segments require higher performance, greater efficiency, and massive scale. SanDisk is positioned to benefit from that shift. One of the most important dynamics here is the transition towards solid-state storage. Traditional hard drives are increasingly being replaced by flash-based solutions because they are faster, more reliable, and more energy efficient. That transition is not finished. In many ways, it is still in the early innings, especially at the enterprise level. And as more workloads move to the cloud and more companies adopt AI, the need for high-performance storage continues to grow. Now here is where things get even more interesting. The storage industry is cyclical. Prices fluctuate based on supply and demand, and companies often go through periods of oversupply followed by tightness. Right now, the industry is coming out of a downturn, and that creates an opportunity. When supply tightens and demand accelerates, pricing power returns, and that is exactly the kind of environment where companies like SanDisk can see significant improvements in both revenue and profitability. Another key driver is the rise of AI. Training large language models and running AI workloads requires enormous amounts of data, not just processing power but storage capacity, and not just any storage, but fast, efficient, high-throughput solutions that can keep up with the demands of modern computing. This is not a temporary trend. AI is likely to drive a sustained increase in data creation and storage requirements over the next decade, and companies that are deeply embedded in that infrastructure stand to benefit. SanDisk is part of that ecosystem. Now let's talk about competitive positioning. Storage might seem like a commodity at first glance, but at scale, it is anything but simple. Manufacturing flash memory requires significant capital investment, advanced technology, and operational expertise. That creates barriers to entry. Not every company can compete at this level, and that limits the number of serious players in the market. At the same time, long-term relationships with enterprise customers and cloud providers matter. Once a company is integrated into a storage ecosystem, switching suppliers is not trivial. This creates a level of stickiness that supports recurring demand. Another factor to consider is innovation. As data requirements evolve, storage solutions must keep up. This includes improvements in density, performance, and cost efficiency. Companies that can innovate in these areas gain a significant advantage. SanDisk has been investing in these capabilities, positioning itself to remain relevant as the industry evolves. Now let's connect this back to growth. The opportunity here is not just about selling more storage devices, it is about participating in a structural expansion of the digital economy. More data creation leads to more storage demand. More AI adoption leads to higher performance requirements. More cloud usage leads to greater scale. And all of these trends reinforce each other. That is what makes this a compelling long-term story. From a financial perspective, the recovery cycle in the storage industry can act as a tailwind. As pricing stabilizes and demand improves, revenue growth can accelerate and margins can expand. This is often when investors start to pay attention, because the narrative shifts from recovery to growth. And when that happens, valuations can re-rate quickly. Now think about this in the context of the Nasdaq. When the market enters a bullish phase, capital tends to flow into sectors that are directly tied to future innovation. Storage is not always the most talked about segment, but it is absolutely essential. Without storage, there is no AI. Without storage, there is no cloud. Without storage, there is no digital economy. That makes companies like SanDisk far more important than they might appear on the surface. And that disconnect between perception and reality is often where opportunities exist. So what you have here is a company positioned at the intersection of several powerful trends, benefiting from both a cyclical recovery and long-term structural growth. That combination is rare, and when it aligns with a broader market upswing, the upside can be significant. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now we move to the final stock, and this one sits at the very foundation of how the internet physically moves data across the world. Every video call, every cloud transaction, every AI query, every streaming session depends on one thing: light. Not metaphorically, but literally. This is where Lumentum Holdings with ticker symbol LITE becomes critical. This is not a consumer-facing company. Most people will never hear its name, but its technology is embedded deep inside the infrastructure that powers the internet, data centers, and next-generation communication systems. And that is exactly what makes it interesting. Lumentum operates in the photonics and optical component space. These components are used in everything from fiber optic communication networks to data centers that support cloud computing and artificial intelligence. As global data consumption increases, the demand for faster and more efficient optical communication systems continues to grow. This is not a short-term trend, it is a structural requirement of the digital age. One of the most important drivers for Lumentum is the expansion of data center infrastructure. As AI workloads scale, data centers require significantly higher bandwidth and faster interconnects to handle massive data flows between servers. Traditional electrical connections are no longer sufficient at scale. Optical solutions provide the speed and efficiency needed for modern computing demands. Lumentum is positioned directly within this transition. Another major growth driver is 5G and next-generation networking. As global telecom networks continue to upgrade, the need for advanced optical components increases. These networks require dense, high-capacity infrastructure to support growing mobile data usage and connected devices. And beyond telecom, there is also enterprise networking and cloud infrastructure expansion. All of these segments rely on optical technology. Now let's talk about why this matters from an investment perspective. Companies like Lumentum tend to operate behind the scenes, which means they are often underappreciated during early stages of growth cycles. But when demand for infrastructure accelerates, these companies can experience sharp revenue inflection points. Because optical components are not optional, they are required to scale the internet itself. And when capital spending increases across hyperscale cloud providers and telecom companies, demand for these components can rise quickly. Another important aspect is technological innovation. Lumentum invests heavily in research and development to improve the performance, efficiency, and integration of its optical products. This includes advancements in laser technology, photonic integration, and high-speed data transmission systems. These improvements are essential because data demands are not just increasing, they are accelerating. AI workloads in particular are pushing infrastructure to its limits. Training models requires massive clusters of GPUs and high-speed interconnects to move data between systems efficiently. Without advanced optical technology, those systems cannot scale effectively. That is where Lumentum plays a critical role. Now let's connect this back to market cycles. When the Nasdaq enters strong expansion phases, infrastructure companies often benefit in the later stages of the cycle. This is because demand for computing power and data transmission tends to lag initial software adoption. First comes software innovation, then comes infrastructure scaling. Lumentum sits firmly in that second phase, and historically, that is when these types of companies can experience strong momentum as capital spending increases across the tech ecosystem. There is also a leverage effect here. Small improvements in demand for optical components can lead to outsized revenue changes because of operating leverage. Once production scales, incremental revenue can flow through to profitability more efficiently. That creates the potential for sharp earnings recovery cycles. So when you combine all of this, you get a company that is not dependent on consumer trends or short-term hype. Instead, it is tied directly to the physical expansion of global data infrastructure. That is a powerful position to be in. Now stepping back, when you look at all three companies together, a clear theme emerges. Palo Alto Networks is protecting the digital world, SanDisk is storing the digital world, and Lumentum is transmitting the digital world. Each one represents a different layer of the same ecosystem: security, storage, and connectivity. And as the Nasdaq continues to evolve, companies that sit at the core infrastructure level often become the quiet beneficiaries of long-term growth cycles. Because regardless of which applications dominate the future, all of them still need the same foundation: secure systems, reliable storage, fast communication. That is the backbone of the digital economy. Now, the real question is not just which company grows the fastest, it is which layer of the infrastructure stack compounds most consistently over time. And that is something worth thinking about as capital rotates into the next phase of market expansion. Before we finish, if you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now here is something to think about. If you had to choose one long-term winner among cybersecurity, data storage, and optical infrastructure, which of these do you believe has the strongest competitive moat over the next decade and why? Drop your thoughts in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.